Hello, fellow Robo Capitals. Hope you're well. So the crash continues in precious metals, kind of. And there is a bizarre twist about the plummet that we have seen in gold and silver that we definitely need to discuss. Could the Fed be manipulating the markets? Could the central bankers be manipulating the markets? Kind of. Not in the way you're thinking, though. We're going to go through this and then connect the dots at the end of this video. So let's dive right in and see what on earth is happening to the price of gold and silver. We'll go over to, let's see, do I have a screen share working there? Yeah, I do. Okay, cool. CNBC. Now we've got gold. Let me refresh. Lots of volatility today, as you would expect. That's what we predicted on the last whiteboard video. You guys saw that. So gold now at 4,700 roughly. Silver about $80. Now that is down from what was the high, 120 plus, something like that. And if you didn't see, Bitcoin was down really big over the weekend, down from maybe low 80s. At one point, it got into where it was trading at a 75 handle, which I thought was really interesting because Saylor is dollar cost average, if you are, the average price paid for Bitcoin, right around 76. So that's something that we'll have to watch carefully and see if that triggers something throughout the rest of the week, assuming that Bitcoin goes down. I don't know. Maybe it rebounds from here. But let's go back to the precious metals. That's what this video is all about. And what I want to do, first and foremost, is go over why this crash is so completely bizarre. I was listening to a podcast today that was talking about the intraday volatility and what we saw Friday, and it exceeds what we saw during the Hunt brothers. They said that it was totally unprecedented. These are some guys that really study this type of stuff. So what we saw on Friday, you have to remember, they're going to be talking about that for a long, long time. That's going to go down in history. I mean, think about how often we talk about the Hunt brothers, right? They're going to be talking about Friday in 20 years. I can assure you. That's how historic the move was. But it was also bizarre, not only from a standpoint of it being completely unprecedented, and we're going to go over the technicals here in a moment, but also from a standpoint of the price, the spot price is significantly higher than the price that we're seeing right here quoted on CNBC. Now, this is a good sign because I just spoke with Keith Weiner. He owns Monetary Metals. Now, he studies this stuff a lot more than I do and the history. And he says that the way that you usually tell if the bull market or the bull move in the precious metals is really fundamentally driven is when you see the spot price trading above the futures price or the paper price, right? Now, he says if you see a bull move that's the opposite, usually that's what's unsustainable. And he says this time we're definitely seeing it where, in his opinion, the way he measures the fundamentals, it's far more sustainable. Now, that means that if we're still in the middle of a bull cycle, we've got a lot further to run, but that doesn't take away the fact that silver was down, call it 30% on Friday, and it takes a long time to recover, or maybe not. I don't know. There's so much volatility. Maybe we shoot back up, but I highly doubt we get back up to that high, like within the next week or two. Now, that said, let's go over to Bullion Volt. I thought they had an interesting article here, and they kind of reiterate what we're saying. Unprecedented crash. See gold sink 21% from record high. Silver price drops 40%. Now, I think that was intraday. And let's see how they're measuring this. Over-the-counter spot gold quotes in London. So they're doing over-the-counter stuff or physical. The global reference rate for bullion prices set by buyers and sellers dealing directly with one another rather than via exchange traded contracts, dropped as much as 10% from Friday's close to hit 4,400. That marked a drop of 21%. And that is from an all-time high set Thursday at 56. So now we could see a bit of a switch there from what I was talking about with Keith, where the paper price could be trading above the spot price. The spot price. London silver prices, meantime, fell as much as 13.7% to $71 per ounce, losing 41% from last week's new all-time spot at 121, at the all-time spot high at 121. So this came out. This is today. Yeah, very, very interesting. That price dropped 21% since the high set on Thursday. Okay, I see what they're saying. And dropped as much as 10% from Friday's close. So we're seeing a lot of action even today. And it looks like it is still selling off here as far as how they're measuring this with the physical swapping hands, the price at which the physical swapping hands per this over-the-counter gold quote in London. Having observed this market for 40 years, this level of volatility is unprecedented. This is what's really bizarre, guys. Really, really bizarre. Well, there's a few things that are bizarre, but this especially. Bruce, and this is according to Bruce Ikmizu, formerly head of giant Chinese bank ICB's Tokyo Precious Metals desk, and now head of Japan Bullion Market Association. A historic rally across metals has turned into an equally historic rout, says derivatives platform Saxo Bank's strategy team. Even with the recent near-term volatility, says analysts from USA's largest bank, JP Morgan, we remain firmly bullish, convicted to gold over the medium term on the back of a clean structural continued diversification trend. Yeah, that makes sense. I mean, their price target for the end of 2026 is 6,300. This is JP Morgan, by the way, JP Morgan. Now let's go over to kind of where I think the Fed steps into the story. I don't think it's with market manipulation. And I discussed that with Keith at great lengths on today's interview. We'll probably post that tonight on the Rebel Capital's interviews channel, so definitely check that out. But most people, I mean, there was so much action in the precious metals on Friday, most people didn't even know that we had the first bank failure of 2026 on Friday. So this was a smaller bank. I think they had 225 roughly million in as far as assets. But based on what we saw in 2025, this is another cockroach. And you just keep seeing more and more and more of these cockroaches. Now, how does this pertain to the Fed? Because you guys know my position on this. I don't think the Fed really does that much in terms of QT. It's all kind of psychological. It's all psyops. It's like the Wizard of Oz. But what I do think is when they come in and bail out the market like they did, let's just say at the late 90s, long-term capital management, they kind of structure that deal. Or when they come in and outright bail things out, the 2008 crash, or when they come in during the cerveza sickness and they take it a step further. What this does is this tells the big financial institutions that, hey, you're too big to fail. So just take as much risk as you possibly can. And what does this lead? And then, by the way, you get this K-shaped recovery as a result. And in that K-shaped recovery, it comes harder and harder for people at the lower end to make ends meet. They feel really divorced from the success that they see around them. When they're following Instagram influencers and whatnot, they're like, wow, these guys are driving around the Lambos and I can barely get a gig as a plumber. So they really feel disenfranchised, might be a better word. And they feel kind of hopeless. And the only thing that they have is really just taking these huge speculative bets. You see? So I think the Fed, by creating this K-shaped recovery, by creating that psychology, by bailing things out, basically saying to these huge financial institutions, take a bunch of risk, and that pushes asset prices higher. What they're doing there is they're creating an environment where you're bound to have cockroaches, right? Because they want to keep the tide in as long as possible. That's what the bailouts, instead of letting the free market work, letting those entities crash, letting those entities fail. And if you do that, then the risk taking moving forward is going to be moderated, because those big financial institutions have to be much more risk averse. So instead of just taking a flyer on, you name the speculative asset, they might instead take that balance sheet capacity and start lending into the real economy. You see, I mean, you got to think what you would do after the GFC if you were a bank. If you're a bank and all your buddies get bailed out, Wall Street gets bailed out, but Main Street doesn't. And moving forward, what would you do with your balance sheet? Would you lend into the financial economy where you know everyone's going to get bailed out? Or would you lend into the real economy where you could possibly take a loss? You see, in the real economy, if you lend after the GFC, if you're one of these big banks, these mega banks, then let's just say you've got 50% upside and maybe 20 or 30% downside. But if you lend into the financial economy, you've got basically zero downside and you've got 100% upside. Where's your asymmetry? Your positive asymmetry, your best asymmetry, is lending into the financial, these huge mega corporations that you know are going to get bailed out. And they just buy their share backs. That makes prices go up. You combine that with the passive bid, and then the market just goes higher and higher and higher and higher and higher. But the only people that are surviving, the only people that are thriving, if you want to put it that way, are the wealthy that actually own the assets, and everyone else is getting crushed. You see how I'm connecting the Fed in here? Where at the end of the day, these bailouts from the Federal Reserve, the central planners, you can throw the government in there as well, they're the ones that are causing all these cockroaches. And I think the cockroaches are the ones, that was the catalyst, in my view, to the market really dropping, or the markets, the precious metals markets, dropping on Friday. Most people blame it on Trump's pick for Fed chair. But to me, that's fake news. Because although you can point to the dollar, supposedly he's more hawkish than the other picks. So the argument there was, he's more hawkish. So the dollar's up and that makes precious metals crash. And that was kind of the pin or the straw that broke the camel's back. But if that were true, you would not see the 2-year treasury go down. And if we look at the 2-year treasury, it's up today quite substantially. But if you look at what it did on Friday, it was straight down substantially, down maybe 4 basis points. So if the market was looking at Warsh, or whatever the hell his name is, and saying, oh my gosh, he's much more hawkish than all the other doves that Trump would have picked, therefore he's likely not going to drop interest rates to the degree to which we thought, and therefore sell precious metals, because precious metals is just, basically a derivative of real interest rates, which I don't think it is, then you would not see the yields on the 2-year treasury go down. You would have seen the yield on the 2-year treasury go up. You would have absolutely seen the yield on the 2-year treasury go up. So why do you see yields go down? Well, this is predicting that the Fed is off sides, and the Fed should, just short term here, this is the knee-jerk reaction, that the Fed should be dropping rates. Why? Because cockroaches. So the cockroaches, in my view, was the main catalyst to everything crashing on Friday. And of course, there was tons of speculative money in silver, tons of speculative money in gold, and that's pretty much, hopefully, washed itself out so we can continue or move on to the next leg of the bull run. And hopefully, if we go into another bull run, it'll be much more healthy than when you just see this parabolic move like that. But at the end of the day, the cockroaches are a derivative, or cockroaches are a result of the Fed bailing everyone out. So I don't think the Fed is responsible from a standpoint of market manipulation or any of that, but I do think they're responsible for, number one, all of this risk taking in the K-shaped economy. And then number two, on Friday, they're responsible for these cockroaches going bust because they're the ones that created the incentive for the cockroaches to begin with. So now let's go back to silver. And I want to, because I know a lot of you are like, what do I do? Do I buy the dip? All these things. Now, I can't give any personal investing advice, but what I can do is share with you what I'm doing in my own portfolio. And if you want more insights like this and kind of contrarian strategies that, by the way, have worked extremely, extremely well over the last year, you can check out Rebel Capitalist Pro. That's the subscription service I have here. You can see with Patrick Sresna, Brent Johnson, Jason Hartman, and Chris McIntosh. We've got Lynn Alden in there occasionally as well. But you can see these trade alerts. In fact, I just did one today, by the way. And if you're following these trade alerts, well, if you would have done what I did, I sold back on Monday, I think it was, of last week. So fortunately, I missed this huge down move. But for me, I'm asking, okay, if I think this is a long-term bull market, which hopefully it is, I think it probably is. I think maybe we're in inning 5 or 6. Where do I get back in? When do I start buying? And for that, I want to look at history. So we see that during the GFC, silver had a down move about 50%. And I believe the down move in gold during 2008 was roughly 30%. But if we zoom out, we know that this was just, call it inning 6 or 7 of gold's and silver massive bull move. You can say that it started, 2000, early 2000s, and it just goes straight up here to the GFC, obviously takes a breather, if you want to call it that, a 50% drawdown. But then that was really the time to get in because, this 50% drawdown takes it to $9, let's say, and then you go straight to almost 50 here in April of 2011. So maybe what we saw on Friday was just a consolidated, super condensed version of this. Now let's go over to and by the way, this move lasted about 10 years. And I remember talking to Brian Lundeen, this was a few months ago, and in his research, he showed that usually these big bull cycles in precious metals last about 10 years. So if that's the case, you could say we're in inning 6 or 7 of this bull move. So then the question becomes, if that's true, if that's what you believe, then how do you play it from here? So let's go over to the candlesticks. And I'm just going to use PSLV as a proxy for silver. And when you see these types of candlesticks, look at the size of these candlesticks. That's healthy. This, a lot of fun, but it ain't healthy. It's kind of like Evel Knievel, that, you see him jump the Grand Canyon or something like that. And you're like, wow, that's really cool. And I'm sure he really had the adrenaline going as he's jumping the Grand Canyon or whatever the hell he's jumping. But at the end of the day, that's playing with fire. Sooner or later, you're going to break some bones. And this is breaking some bones right here. This is what it looks like in terms of charts. And you can see these candlesticks just get bigger and bigger and bigger, and these gap ups get higher and higher and higher. This is unsustainable. So then you get this big down move. This was Friday, of course. But now look what we're seeing today, to where the price is lower. That is true, just based on the PSLV. The price is lower than where we closed on Friday. But look at where we got intraday, all the way down to, I'm just eyeballing it here, call it $23.80. And then we go straight up to where we are today, $25.87. Now, I'm no technical analysis pro, but I do know that when you see a big move down or you see a big move up, and then you see a candlestick that looks like this, where the low point of the day is way, way, way below the close, and where it trades into the close is just buying. That's usually when you get all the volume kind of buying the dip. That's a good sign. That's a really good sign. So the way I'm looking at this now is I'll have to see where this closes. It's 340 right now, roughly. If this closes like up near 20, well, not 26, but if this closes, yeah, if this closes over 26, that is a good sign. And I could be very, very tempted to take a little bit of a speculative bite there on the long side. A little bit of a speculative bite. But if I do, I'll definitely do a trade alert for Rebel Capitalist Pro members. That I can assure you of. So in summary here, I think the Fed is really the root cause, because I think Friday, the catalyst, or the straw that broke the camel's back, wasn't really Warsh, but it's more likely the market seeing more cockroaches and being very concerned that we could see more and bigger cockroaches throughout the rest of 2026. And therefore, if they've got all these leverage positions, risk on, they're like, yeah, risk off. And then you just get this big reversal, this unwinding. And that's probably what we saw in precious metals. But we wouldn't have the cockroaches if it wasn't for the Fed bailing everyone out. So at the end of the day, you got to point your finger, at least I do, at the central planners. Now, moving forward, we got to look at history and see that these bull trends usually go 10 years. And then we have to look at the GFC. Not that we had a big liquidity event, but we did have a big down move. That took a few months. We could have seen that few months play out in just a couple days last week, which is, again, why this is so bizarre and why it truly is unprecedented. It was historic what we saw on Friday, and they're going to be talking about this probably for decades to come. And then for me, moving forward, again, not investment advice, but I'm just looking at those candlesticks, and it tempting on the long side, but we'll have to see how it plays out. And where I would get really tempted, is if we start to see an uptrend where we get 3 or 4 higher highs and higher lows. And especially if we start to see candlesticks that look more like this, that are this big instead of that big. That's the easiest way to describe it. You want to play the game when the candlesticks are this big, not when they're that big. Often the best trading advice or the best investing advice is the most simple. So just remember that. Candlesticks small, bullish trend, good. Candlesticks big, bad, danger, stranger danger. So that's the main takeaway for this video. On that bombshell, guys, if you want to check out Rebel Capitalist Pro, Josh put a link in the description and in the chat here. And as always, make sure you're standing up for freedom, liberty, free market capitalism, where we wouldn't have the central planners bailing everyone out, creating perverse incentives, creating all of the cockroaches that we're seeing go bust in 2025 and likely in 2026. That is leading to all of this volatility. Rant over. We'll see you in the next video.